what will Trump do to the housing market? Trump's going to come in and everything's going to go great. Trump's going to come in and this whole thing is going down. There's not going to be an instantaneous change. We're not going to see the market just immediately recover. All of a sudden, the housing market's on fire.
Since Trump was elected, interest rates have gone up about 0.5%, which is big. Tax cuts affect government revenue, which affects bonds, which make interest rates go up. If we do massive tax cuts, we could see higher interest rates. In theory, interest rates would go up if you had massive tax cuts.
Let's just look at historical data, what that potentially did to the market. So 2016 to 2020.
So you have an inventory challenge and then a massive number of buyers. It was just really a perfect storm.
Okay, what will Trump do to the housing market? And just a disclosure from the very beginning, we're not going to talk politics. We are going to talk about economics. We're going to talk about some of the factors, some of the variables that weigh into what makes the market move. And, you know, a lot of people are coming into this. Some people are coming into it positively, like, hey, Trump's going to come in and everything's going to go great. Some people are like, Trump's going to come in and this whole thing is going down. But let's just talk real talk about what this potentially has the potential to do in the housing market. And what I would tell you just initially as we get out of the gate, there's not going to be an instantaneous change, right? We're not going to see the market just immediately recover. Rates go down to 4%. All of a sudden, the housing market's on fire. That is not happening, right? What we might see is some things change that affect, create maybe a domino effect. So we're going to talk about that. So first, let's talk about tariffs, because that's been a lot of talk in the news about Trump tariffs. They've affected the stock market. What he's going to do on those tariffs have affected the stock market. So our local economist, RL, is going to help us with that. So,
well, here's what I think is interesting. And here's what I'll say. You kind of gave the warning about the political aspect of this. And here's what I'll say. Like, we're going to talk about how you pull certain strings and what might happen in the economy. But what we're learning now more than ever, and I guess social media, is how you frame certain things has a large impact on how they're received. So tariffs, you mentioned tariffs, so we'll start there, right? So like everybody thought that Trump was going to, first day in office was impose these massive tariffs. And so since Trump was elected, interest rates have gone up about 0.5%, which is big. I mean, big.
That's big.
And so, people were like, well, what's going on? I thought Trump, promised we're going to go to 2% and he's going to crush inflation. But here's the thing, initially he said, I'm going to impose these massive tariffs day one. We're going to get started on it. And when he took office, he like softened it. Like everything he talked about was a lot softer than before he took office. And so that softening has eased interest rates a little bit since he's kind of made those statements. So how you frame certain things is having a big impact. I mean, sometimes wild impact on what interest rates do the following day. So just keep that in mind. So,
well, yeah, it's interesting. It's almost like he said things that would like maybe be, great sound bites for a campaign, but maybe it's like, well, we're going to.
They all do that.
Exactly.
They all do that.
Every single one. Yeah.
But I mean, fact of the matter is, if you were to impose tariffs on a large number of goods that are being imported, in theory, it would increase inflation, which is bad for interest rates. Yeah. So interest rates would continue to climb, or at the very least, not go down.
I heard him say at one point, I guess, Tim Cook, who's the Apple CEO, called him. That's like, hey, Mr. President, if you do this tariffs, it's going to kill our profit margins and we're going to go under. Can you give us a 2-year stay? He's like, and so I gave him a 2-year stay on those tariffs, to get, but I said, you got to have manufacturing, such and such percentage of your manufacturing moved to the US. And he goes, okay. And so there's what is being said, a lot of times, which is soundbite material, and then actually how that actually plays out. And the stock market reflected that in terms of like Trump saying, because the stock market was a little bit in turmoil, and then it went up because the tariff stuff wasn't as bad as he said it was going to be.
Yeah. I mean, the other thing we could talk about is tax cuts. And, tax cuts affect government revenue, which affects bonds, which make interest rates go up.
Okay.
So, you cut taxes from Trump's perspective. It helps a lot of Americans, yes. Yeah. But bonds are affected and rates are affected. So that's another one where it's like, hey, if we do massive tax cuts, we could see higher interest rates. Right. And again, I say could because there's a lot of, economic factors at play, like maybe people, because they have tax cuts, maybe they have a little more cash in their pocket and they do start to purchase homes. There's a lot of things here, but in theory, interest rates would go up if you had massive tax cuts.
Yeah, that's absolutely right. And that's just, it's not, we're not saying that, again, it's not a political deal. It's just like, that's kind of what we know to be the sort of strings that are pulled and how they affect the marketplace. What else? Do we need to talk about interest rates?
Yeah. I mean, some other policies that could affect it would be like mass deportation of skilled workers.
Yeah.
So like, you have like builders who rely on, a lot of people sometimes that aren't
That's right.
fully legal. And if you have mass deportation, that would certainly put a burden on an industry that is already suffering from not enough skilled workers. So that could affect things.
Sure.
And again, interest rates have gone up 0.5% since Trump was elected, but that doesn't mean all that much quite yet. And like you said, none of this is going to happen immediately. Like this is all going to take some time. Deregulation could increase construction costs. So like right now, industry is very highly regulated. If you deregulate it, it could increase construction costs and help supply. Sure. Increase the number of construction and help supply. Sorry,
Right.
That's a positive. And then if we increase drilling, oil prices fall and all goods and services go down, go down in price. So that's a good thing for the market. So there's some pros and cons to some of the policies that's been talked about. I would say oil prices going down would be a major plus. But.
Well, my dad's been in the construction business for 40 years, and I can tell you just from being in and around the construction business, a lot of times you're right. If as the construction, let's say it deregulates and then ramps up a little bit, well, what happens is you're also fighting over subcontractors, and so it can delay the completion date, and that can also cause that can have economic that can be another economic factor. So it's like you can't move one thing without it affecting the other.
Yeah, that's right. I think that's the biggest takeaway here is like, look, there's a lot of factors at play, and a lot of things get changed as new administration changes. And so like, if you change one thing, other things might change. Or if you change three things, six things might change. So we don't really know exactly what's going to happen. But in theory, if you take any one of these at face value and you start adjusting it, this is in theory what would happen as a result.
Right. And I want to talk about, one of the things we as we were prepping for this episode, I said, let's just look at historical data. And really, I wanted to sort of take the last time Trump was in office in terms of what that potentially did to the market. So 2016 to 2020, of course. So the housing market was strong in 2016 to 2018. So that 2-year period. And then 2018 was a massive year for first-time home buyers.
Yeah, at the time, one of the largest in the last couple decades.
Do you remember what the percentage was in 2018?
No,
Okay.
I don't remember any percentages, but just as far they were outpacing the other buyers by double-digit percentages.
Right. And then in 2019, inventory went down; it declined.
We start to see a decline in inventory. Obviously, if you have a couple years of a pretty hot market, you're going to start to see some inventory challenges. And then as you work your way through 19, you start to hit COVID at the end.
Right.
And then, everything stops. And so as you enter into 2020, we have, an inventory problem, which sent prices skyrocketing. Everybody wanted to buy because they were bored. They were sitting around their house. They didn't like their house anymore because that's where they were staying. So you have an inventory challenge and then a massive number of buyers. Sure. And, that created kind of the COVID market. It was just really a perfect storm.
It was a crazy, yeah. And I remember in 2019 just thinking like, hey, what's going on with the market right now? Because it didn't feel like it just wasn't moving very well. And, 2020 happened. And then, of course, everything just went crazy. But I remember even the sort of third and fourth quarter of 2019 kind of going, hey, what's going on? This is a funky market. And then it all sort of just shifted. Second quarter of 2020.
But in reality, I mean, builders were starting to get behind in 2018. Yeah. So we have a market that's going, at a good clip, 16 to 18. Builders start to get behind in 18, get really behind in 19, get really behind in 2020 and 2021. Sure. And here's where we are, right? Like it's almost impossible for them to catch up. It's not happening. So that's what is keeping our prices. Some people call them inflated. Some people call them just high or whatever you want to call it. But prices are high because inventory is low and demand is still up. Yeah. So, I mean, it's basic economics, right? So as long as people want to buy homes and there's not enough of them, prices are going to remain up.
What would you tell real estate agents though, that they're like, hey, I don't feel like, inventory is low and there's like a supply of buyers, or that, the supply demand. Like I'm looking at my lot, my life as a real estate agent, I'm seeing fewer transactions. Like what would you tell those real estate agents is happening, for them personally?
Yeah, I mean, there's affordability challenge. So
Yeah.
again, like while you have a large number of people that want to buy and can buy, you also have a lot of people that want to buy and can't buy. So, the homes that are sitting out there, at least in our market, I think are largely not priced appropriately.
Yeah.
I mean, people hang on to an idea that their home, might have been worth at the peak of COVID X, and
Yes.
now it's worth Y, and they don't want to let it go. And so, they're very reluctant to pull the trigger because, they're sitting on a 3% interest rate. And once they sell it, they're going to 6. And
Yes.
so, they're not just going to give it away.
Well, I had a client, I've got a client that I'm working with right now that, it's very sort of typical, exactly what you're talking about, basically looking at past data, to basically determine the sale price of their home, and kind of, got dollar signs in their eyes a little bit. And so one of the things that I was telling her is I'm breaking it down, and I go, hey, look, if we're looking at these numbers here, tell me what, like I want to align with you on your strategy to sell your home. Tell me what's going on in terms of where you're coming up with your number. And then she kind of gave me, she goes, well, this unit sold for this, and this unit, because she's in a condo high rise in downtown Nashville. This unit sold for this, and this unit sold for this. And so I said, okay, what were the numbers of those units? I'll take a look at them because they're not showing up in my data. So I go back and I look at the data, and not only were they, different, size than hers, and different, level of remodel than hers, but it was April of 22. I'm like, well, yeah, April of 22 is a completely different market than January of 25.
Yeah, no question about that.
We're almost 3 years removed, and basically she's held onto that data. So that's a perfect example of sellers right now. They're holding on to old data from a massive market high. I'm like, that's not reflective of any kind of market that we're in right now.
Yeah, and I think here's the thing, like, and I had a seller I was working with that had this same problem, right? So they bought their home, $2.5 million home, really started building it in the height of COVID and closed on it like right at the end of COVID. So obviously all the negotiations were done during COVID, right?
Yeah.
And so they go to sell this thing 2 years later, just enough to get them out of capital gains hit. And it had appreciated like 150 grand. $2.5 million home.
Right.
But that wasn't good enough because they had seen the 50% appreciation around them and all these different things. And so people don't realize that, hey, look, you might not get that height of COVID number, but look at what the home was worth right before that.
Yeah.
And then now.
Yes.
And it's still, the trajectory is still up. Even though it kind of went down just slightly from 20 offers at the same time, like no inspection kind of deal. It's still up from where it was before. And that's the key, right? It's like people look at appreciation in too finite periods. It needs to be looked at kind of on a longer trajectory.
That's exactly, there was the same thing. Cause I'm like, hey, look, really from the time you bought this house to the time you're looking to make $100,000, right? Which, according to the value of the property, it's about 20% over a 4-year period, right? So we're looking at 5% year over year graduation or ROI. And the person before her that bought it and sold it had like 3.5%.
Yeah.
And, once you average the return, so, what they bought it for and what they sold it for. So I'm like, look, you came into this house in 2020, you're going to sell it, into 2020, you're going to sell it in 25. You're going to make $100-something thousand, tax-free, by the way, because it's a primary residence. Do that.
Yeah. People need to forget about the COVID numbers. And if you're getting anything north of 5% year over year, you're doing just fine.
Yeah.
Like, and that's what people need to understand. And again, I understand, I get it, right? So you don't want to let that house go because you're going to have to trade it for a 6% interest rate. I totally get it.
Mm-hmm.
But, if you want to move and it's important for your family and you're still seeing that, level of appreciation we've talked about, then, it's a decision you need to make. Like, do you really want to sell this thing?
Well, and even, the sort of overpricing, because Wall Street just generally feels like things are overpriced. There was an article that came out in Real Estate News the other day and talking about, and I think in the Wall Street Journal, just about general pricing of houses and that Wall Street feels it's overpriced. Now, I do have a caveat to that, which is like, well, when I'm looking at Real Estate News, I'm taking into account, and by the way, you have to remember, again, we've said this before, media, right? They're going for clicks. So they're going to come up with salacious headlines to get you to click on them. So if you see a headline, and that I fell victim to this, it's like Wall Street thinks housing prices or houses are overpriced, and it was sent to me by a friend. And so I clicked on it and read it. But one of the things that I kind of remember is probably most of our listeners are sort of in the middle part of America. You guys that are in New York, LA, Chicago, your market doesn't move like Middle America market, right? And your values don't reflect Middle America values in terms of home values, right? And so a lot of times these articles are written with those sort of 3 or 4 major markets in mind and not sort of where all the rest of us are sort of operating. So that's one thing to consider when you're reading these articles, but I'd love to hear from you if you took anything away from that.
I mean, the fact of the matter is investors aren't buying right now.
Yeah.
They're seeing like that 4% cap rate, and they need to see like 6+ to really make sense.
Yes.
5 would be fine, but 6+ is what they really need to see. And so, the article you read, I don't know, I didn't read the same one, but I'm assuming it said something like, Wall Street believes we're 10 to 35%
Sure.
Overvalued.
Yeah.
And from an investor standpoint, they're right. Like investors aren't buying right now. It doesn't make a lot of sense right now. They can't make the numbers work.
Mm-hmm.
But, in my opinion, it's really more about affordability, right? So like houses are getting, are outpacing income.
Yes.
Unlike they did, for our grandparents and whatnot. But houses are outpacing income. Interest rates are up. Insurance costs are up. Nobody's talking about that. But
It's killing people.
California is about to see. I mean, there's going to be companies that go bankrupt, obviously, out there.
For sure.
Florida is constantly seeing more and more hurricane damage, and their interest rates or their insurance costs are going up.
Yep.
And then you've got this limited supply thing. So all these factors come into play with affordability. And as long as inventory's low, insurance costs are up, rates are up, you've got this challenge where it just doesn't make a lot of sense for investors to jump in right now.
Yeah.
And so I think that's where Wall Street's head's at, is like, from an investor standpoint, this is not making sense.
Yeah, that's probably exactly right. And I guess probably that slowed, the purchasing from a lot of these, real estate investment trusts.
Yeah, that's right.
That's what a lot of, is reflected, those hedge funds. But when it comes to insurance costs, I was talking to an agent, one of our followers, about Charleston, and they were saying, yeah, that the insurance cost for Charleston has gone sky high. And then basically it's like, if you look at all of the sort of events that have happened over the last year, it's like the end times or something, right? Because we had big hurricanes that caused massive flooding in central parts of the United States. You're not thinking this is going to happen in Asheville, North Carolina, but just got completely wrecked with rain. You've got fires, hurricanes and fires and flooding and like all of this stuff.
West coast of Florida was hit twice.
And so these insurance companies really, if they're going to stay in business, they have no choice but to raise costs.
Yeah, and people think that only California, Asheville, North Carolina, Florida is going to be affected. No, everybody's insurance is going to go up.
That's right.
And that's why, 2 years ago, we saw that massive 10% bump nationwide, because as we have more and more natural disasters, or at least these kind of large scale natural disasters that we've seen, like everybody's insurance is going to go up to accommodate it. And so it's going to happen again. We're going to come out of 2024 into 2025 and 2026 when these premiums start to reset.
Mm-hmm. Yeah. So we're seeing affordability issues, and then, but there's this other thing, which is sort of the sort of variable that you can't really track, which is consumer confidence, right?
Well,
how does that play into the market in terms of, making it move?
Yeah, I mean, obviously, high consumer confidence leads to more spending, leads to a better economy, leads to things like that, but it also leads to higher interest rates.
Yeah.
So, until we start to see a drop off in like consumer spending, interest rates are going to stay up, because inflation, because people can increase the price of goods when people are still buying these at large, quantities.
Sure.
And so, inflation is going to, be the result. And until we get that under control, I don't see how interest rates can go down. And, we could do something from a political standpoint, but it wouldn't be good for the long term.
Sure.
I mean, these are all things that, you can pull some strings and make things happen, but at what cost?
Yeah. Okay. And then do you see, like, if you're looking at the stock market every day, and you're probably watching this a lot closer than I am in terms of your interest rates, stock market, all that stuff, is there any sort of correlation there?
Yeah, absolutely. I mean, so like housing and stock markets are influenced by interest rates, obviously, for obvious reasons. Both are influenced by inflation. So inflation's up, that influences both of those. Consumer sentiment, which we just talked about, influences them. Home values increase, borrowers have more to invest, so that those types of things affect kind of the stock market. So all of those things are correlated. Now, does one directly affect the other? No, but they have like bearing on how things play out.
Sure. And I guess, it sounds like we're being negative and we're not, right? We are being very like, hey, real about, hey, over the course of the next, couple of years, we don't really know exactly what's going to happen. Things are not going to change automatically just because we've got, a new administration in office. But I mean, what do you think generally, though, moving into the next couple of years for real estate?
I think in order for us to see some like real change in interest rates, which I mean, hey, we're focused on interest rates now, but like as far as healthy markets are concerned, we're right there.
Yeah.
Like, would we want to see them in the high fives, low sixes? Yeah. But like, we're really close to what a healthy market could sustain for a long period of time.
Yes.
So yeah, I hate to push too hard on interest rates, but until we see some pain in the economy, job creation slow down, inflation goes down, things like that, then interest rates are not going to do anything. And if you want interest rates to come down, the economy has to see some pain.
Right. And so the question is like, well, what should I be doing as a real estate agent, in terms of like, okay, so we've talked a lot about the economics here, but like, what should I be doing as a real estate agent? And we've been, I feel like we've been beating the drum here for the better part of a year, but it's like, this is again, your opportunity. Now, there are closings that happen every single day.
Yeah, no, you can close in any market.
You can close in any market, right? Somebody's always buying. So it's just about identifying who those buyers are and marketing effectively, to the consumers that are out there to buy. Now, but again, as far as what I was beating the drum about is you as a professional real estate agent versus being someone that can phone it in. That's where I see the biggest drop off in terms of real estate agents is the gap is getting bigger between who is successful and who isn't. And I think we wrapped up as like 70% of real estate agents didn't sell anything last year. Okay. Does that mean there weren't real estate realtors getting rich? No. But a big portion of people that came in during, where you could be in for a month and your, best friend wanted to get 2.9% interest rate. That was a completely different market. And we're never going to see that again unless we have a major, another pandemic. But what I would say is like, again, this is your opportunity to become the professional.
Yeah. A massive, I don't even know the percentages or the numbers. I probably should, but how many, mortgage professionals did not renew. So our renewal cycles are a little bit different than real estate professionals, right? So you guys are all on, or we, because I am one as well, but you renew when it's time to renew, like based on when you got your license in the first place, right? So if you got your license in July, you're going to renew every July. Well, mortgage professionals are all in the same renewal cycle. So we all renew by December 31st and we start the year. Massive number didn't renew. Like one of the largest drops they've ever seen. And that just shows you, right? Like people are worried about the path forward. Well, what I see is, hey, look, it's time to shine now. Like the people that just dropped out weren't ready to put in the work.
That's right.
You're here, you are. So do it. And honestly, I mean, like you just said, people are always going to buy and sell in every market. And the big players in your market, the real estate professionals that are selling, $30 million a year, they can't take them all.
Yeah.
And so, just keep up with your sphere, with the people around you, with, making your cold calls, doing this, doing that. And I promise you there will be more than enough business to go around because people are buying and selling every day. Yeah.
Here's what I'll tell you. Work works. Okay. But you've got to be ready to grab onto those opportunities as they're presented to you by being informed, like by doing things like listening to this podcast, because here's the thing. And this is something that I've noticed, being out in the field, working with clients, they have a lot more questions around economics.
Yeah.
They have a lot more questions about what the market is doing. They have a lot more questions. They want the person that's buying now is a far more informed consumer, in my opinion. And the real estate agents that I'm dealing with on the other side of these transactions are far more professional, because it's like, okay, well, they've worked their way, like they're the professionals that are out there making things happen.
Yeah.
And so you just have to make the decision to be the professional or not.
The longer this real estate cycle lasts, and it just, frankly, it just hasn't been great. The longer that this lasts, the more that phrase, like, everybody knows a realtor, is going to go away.
That's right.
And so, like, you're going to be there, assuming you make it through. Hopefully you make it through. You're going to be there to be the one that they do know.
Yeah.
And I think that's the most important takeaway from all this is like, hey, look, as people wash out, and I don't want people to wash out. I'm not saying that, but as people wash out, good. Let's turn it into a positive. Let's get out there. Let's do the work. And I promise you, there's going to be plenty of business to go around.
Absolutely. Be the professional out there. All right. Thank you guys for joining us. Make sure to like, subscribe, join us next week. We'll see you then.